Hey everyone, welcome to another video on bonds. We'll look at ratings in just one moment, but first we'll circle back to coupon rates and yield to maturity, explain more of the relationship they have. We will look at bond ratings and understand how it affects the price of a bond. And then finally, we will be pricing some government bonds, notes, and bills. So let's circle back to our two rates. The first is the yield to maturity, and this is really the expected return of the entire investment. Okay. Now this has a lot to do with the price of the bond, and just like any other asset that's being traded, the price is constantly changing, and it's really depending a lot on sort of supply and demand, buyers versus sellers. Okay. Now there's a lot of factors out there, and we will discuss specifically interest rates, but it's important to understand that it is a fluctuating rate constantly being changed. In terms of calculating the yield to maturity, well, it's similar to calculating the present value or the price of a bond, which we've done before, but now we're given the price of the bond or the present value, and we simply now have to calculate the yield to maturity. So really, once we know the price and the future value, and given the payments that we can expect, we can figure out what that overall expected rate of return will be. Now that's the first rate. The second, or the other interest rate, is a little less complicated, is the coupon rate. The reason why it's not as complicated is because it is a fixed rate. It does not change throughout the entire time the bond is issued by the company, right? And really, it again shows that income or that interest that's earned on an annual basis or some sort of equal payment annuity over the life of the bond. So an example would be if the coupon rate by the company was set at 7%, well, then we know that the firm is going to be paying that lender $70 per year on each bond. 1,000 represents the par value, and that's how we determine the coupon payment. The payment can also be made, in two periods within the year, and then we would expect a payment of $35 times two instead of just the one $70 payment. Now, what is the relationship between these two? Very interesting. Well, comparing the two, we can understand whether or not we're dealing with a par, premium, or discount bond. So what do we mean by that? Well, if the coupon rate is equal to the yield to maturity, then that means the bond is sold at par. Okay, that's what we expect. Basically, we don't expect any value changes. However, just like any asset that's being traded, particularly in terms of expectations, if the investors expect a higher yield, prices will go down. Okay. And we'll talk more about that in a moment, okay? And that's when we will see the bond being sold at a discount, okay? Or vice versa, and the vice versa just basically means that if we expect lower yields, that means the price will actually go up and it'll be sold at a premium, which would mean above the par value. So basically, really, there's three things that are happening. So first, the coupon rate can be equal to the yield to maturity, and that's what we mean by the par bound. But sometimes the coupon rate can be higher than the yield to maturity. That's premium. And finally, if the rate is lower, then it's considered a discount bond. So I know that's something to start thinking about. Let's look at it again here, in terms of the relationship, right? And hopefully this will help us understand some of the factors that go into yield to maturity or pricing. So again, premium bonds, the reason why investors are willing to pay at a premium is because they're actually getting a higher coupon rate. Okay, so they're getting a better coupon rate compared to the yield to maturity. Okay, now when we're looking at a discount bond, what's happening, and really just to keep it simple, think of a premium bond, there's more demand for it because it's a better investment option compared when the yield to maturity is lower than the coupon rate. And we'll talk about that in just a moment. Discount bond, opposite is true. So the coupon rate is lower than the yield to maturity, It's not as desirable. So therefore, we're selling our bonds at a lower price because we can basically get a better option out there. We can probably buy a bond, a newer issued bond that has a higher coupon rate. So how does this kind of relate to interest rates? Well, if you think about interest rates in terms of opportunity, if interest rates are going up, that means basically what that means is there's better investment opportunities out there. Okay, so what happens to the bonds that people have? They typically might want to sell their bonds. The prices will drop. Okay, because remember, bond prices, the value of bonds is that fixed income that we will get. Now, the good thing about a fixed income is it obviously doesn't change. But however, when interest rates go up, that fixed income doesn't seem to be as desirable anymore. Now, the opposite is true. So there's an inverse relationship. If interest rates go down, then bond prices are actually they're more desirable. And remember that fixed income, particularly if the coupon rate is higher than those interest rates, that's a good thing. That means that people want to buy bonds, they're more desirable, and they're willing to pay a premium for it. Okay, so that's really just a simple kind of explanation as to why interest rates play a role in bond prices, and really just think about it in terms of demand for bonds. Now, another factor in terms of bond pricing is bond ratings. Okay, so bonds can be rated, and they are rated. And typically companies like S&P or Moody's and Fitch, they are companies that will specialize in ranking bonds. Typically, they're generally the same type of ratings, a little different, but for the most part, we start with AAA. Those are our top rated. Then we have C, which are our lowest rated. And then finally, we have D, which is our default. Now, this rating should indicate or give you a clue as to what we're actually rating. And basically what we're rating is the likelihood of default. Okay, so if you recall back to our risk premium, basically what we're trying to understand is those AAA rated bonds signify that they have the least risk associated with them. Okay, now in terms of pricing, what that might actually mean is that bonds that are highly rated might have actually they do have less risk associated, so they might actually have a lower yield. Okay, but again, these companies help sort of issue that newly issued bond, understand the proper yield that's associated with that bond. Just a little kind of terminology to throw at you. So when we refer to junk bonds, this is sort of I wouldn't say street term, but it's a bit of a slang, and really just refers to more speculative, less secure bonds that are rated a little bit lower. Okay, and then we also have what's considered falling angels, which are bonds that were once had a high rating, but now have gone down to a speculative grade. Therefore, they've fallen from their rating. So again, here is a table for our rated bonds here, just to get an idea. And again, just because you invest in a highly rated bond doesn't always mean it's the best investment. It just means it's the more secure investment. Okay, because the bonds rating simply tells you the degree of risk the company issuing or the issuing company will default on its obligations. Right. So the lower the rating, the higher the yield will be, and the higher the rating, the safer your money will be. Okay, so there's a bit of a trade-off between security and yields. So let's now move on to types of bonds, okay? And really these bonds are just dependent on the length of the issuing bond. So we have bills, notes, and bonds, right? And really the ones that issue them it can be based off of governments, state or provincial, maybe it might be municipal bonds, really just specific to who's actually trying to raise the capital, okay? Now, the reason why treasury bills are considered zero coupon is because these are the shortest loans. And if you notice here, they're actually range the maximum up to a year. Okay, so they're very short-term loans. And really, if you think about it, you can't have a a bill paying a coupon because they're usually annual payments. So these don't actually pay out any payments. So it's good to understand why treasury bills are zero coupon. And again, the bill is really signifying the length of the bill of the investment, which are very much short term. So we're looking at, it could even be 1 to 3 months, very short term, maximum of a year. Treasury notes, now they're from 2 to 10 years. And then finally, we have bonds, which are greater than 10 years. So here we just have an example of some differences between notes and bonds. And regardless of what the current date is, we can at least recognize that these are shorter maturity dates compared to these. Okay. One thing you might also notice now that you're all caught up on yield to maturity versus coupon rate, you can see that we can see some premium bonds. That is bonds where the coupon rate is greater than the yield to maturity. Okay, so you can see here we have some of those here. We'll also notice that the price is above par value, right? So again, we're paying premium for the price versus this note here on May 2005. We actually see that the coupon rate is lower than the yield to maturity, and it's selling at a discount. Okay, so we're starting to pick up on some things. I know. So how do we price these bonds? Okay, well, very similar to what we've already experienced so far. Okay, just some things to always remind ourselves, and that is just making sure that we have the right number of payments. So in this case, we're dealing with semi-annual. Okay, and that's why it's so helpful to write out a timeline. Okay, because we can actually see that we recognize that the number of payments are actually 14 instead of 7. Even though it's a 7-year bond, we know that we're actually going to get paid out 14 times because it's semi-annual, right? One thing we also understand too is the payments themselves, because they're semi-annual, are 3,000 as opposed to 6,000, right? So again, if we want to calculate our coupon payments, we would take the face value times the coupon rate, and because we're dividing it by 2, or because it's semi-annual, we're dividing by 2, so we know that we have $3,000 for our payments every 2 years. Okay, and that's why, just a reminder, it's so important to make sure that you have the right settings. In this case, we're making sure our settings are correct in our calculator, but we'll do the same thing when we're dealing with our spreadsheet. And finally, pricing out a treasury bill. So, as we sort of mentioned already, treasury bills are much shorter in time. And in order to actually figure out the value of our treasury bill, we have to use a little bit different calculations. Okay. Again, I won't spend too much time on this just because you'll look at it in regards to our Excel calculations. Okay. But we do have to use a sort of special discount yield. Okay. And you'll see this sometimes written as a BEY. And what's important to note about this, just in terms of a theory, is that it's similar to the APR, okay, so the annual percent rate, in the sense that it's something that's quoted. And we like to use this bond equivalent yield because it helps us compare our options. Okay, so even though treasury bills are sometimes even less than a year, the bond equivalent yield helps us calculate a annual yield on that investment. And again, formula is here, but we'll spend more time calculating. We'll do a quick example here. And in this case, we're going to calculate both the price and the bond equivalent yield of a treasury bill. So in this case, again, we have a bill and it's maturing quite quickly, 105 days. Okay, we know the face value. And again, we have the bank discount yield of 2.62%. So first, we want to figure out the price of the treasury bill. Okay, we have our formula that we can use, and we'll go ahead and do that. And you can see we get a price of about $9,923. Okay. So now that we have basically the price or the present value, and we know the face value of the $10,000, we can use our formula to really just figure out the yield on that return. Okay, again, there's a formula there. But no worry, I know it's not easy to see this. We'll take a look at it more on Excel. For now, just think about the theory. So again, we've explained the relationship between coupon rate, yield to maturity. We discussed bond ratings and sometimes how they affect the price. And finally, we have just looked at some examples on pricing bonds, notes, and bills. Thanks for watching and happy financing.